Good afternoon, everyone, and thank you for joining us today. It is a rainy spring day in New York. We hope the weather is better wherever you are. I'm Robin Thoreau, and I'm the co-head of the RIA and Family Office Group here at Barron Capital. Welcome to our Barron Capital Thought Leadership Forum. Today we will discuss U.S. policy and the strong tailwinds in place for non-U.S. equities. And thankfully, I'm here with our resident experts in this space of everything non-U.S. We will be joined by Michael Kass, who is the portfolio manager of Barron International Growth Fund, Barron Emerging Markets Fund, and he is the portfolio manager advisor on Barron India Fund. We'll also be joined by Anuj Aggarwal, who is the Assistant PM of Barron India Fund, as well as the lead portfolio manager, or the Assistant PM on Barron Emerging Markets Fund, and the lead portfolio manager on Barron India Fund. Between the two of them, they have over 55 years of research experience, and so we are happy to have them as a resource for our clients. Before we get started, a quick note, we will be taking questions, and we've already had some come in, so thank you for those. To submit a question, you can enter it through the chat box on the bottom of your screen, and you can also resize the slides by dragging them in the edge of the presentation to make them larger. So now that that's out of the way, Michael and Anuj, welcome. I know you both have been discussing the improving fundamentals for EM in India for quite a long time. Probably felt like screaming into a vacuum for a little bit for you, but following Liberation Day, a lot of things have changed, right? And there seem to be some significant catalysts that are drawing attention to the improving and now attractive backdrop for non-U.S. equities. And so I'd love to kick it off of you walking us through how you're navigating that new environment.
We would love to.
Yeah, a lot to talk about.
It's our favorite subject. So thanks again, Robin. As you mentioned, we have been talking for some time about the improving fundamentals, really the earnings growth outlook for emerging market equities. And yes, it's kind of fallen under the radar screen. Most people are really not, aware of some of the catalysts that we see. And so, I want to spend a little time, laying out the key fundamental drivers as we see them. Obviously, you have higher structural growth in emerging markets, but, it's really more about the improving outlook for dropping, growth into earnings power. And we think some of those catalysts are really deglobalization itself and supply chain diversification. We think that requires a sustained global capital investment cycle. That's an underappreciated catalyst for EM and international earnings. We see obviously supply chain moving, whether that's Latin America, Asia, India particularly. Global security, we would call out defense spending we see that in Europe, but also throughout Asia now. Countries that are becoming more self-reliant in terms of their own defense spending as the U.S. is backing away, and we'll talk more about that in a minute. Defense shipbuilding is another area that's dominated by international companies, and there is kind of a growing appreciation for the lack of investment there and the need to restore. Much of that moves from commercial to military. But those are some of the examples that we see supply that the new environment of global security, deglobalization, is driving in our universe. India, and Anuj is going to talk a lot about, the appeal and the excitement, enthusiasm we have towards India. But India is the fastest growing major economy, 6 to 8% real growth. It's the number 2 weight in the emerging market index. We think it's a matter of time before it becomes the anchor weight, and we think investors will take a different approach and look at EM differently as an asset class when they realize that India is going to become the fastest growing economy, and most efficient growing economy is going to become the largest weight in the index at some point. Next, AI. It's hard to avoid, this sort of, no matter where you're investing, AI and the productivity gains by AI look to be very significant for decades to come. But the AI ecosystem really extends into emerging markets. I think investors are becoming more familiar, appreciating this more, but particularly Taiwan, Korea, we see lots of opportunities there and have made a number of exciting investments. In LATAM and Brazil, particularly, we're very attracted to fintech and credit penetration. But Brazil and Latin America also would be, kind of the most levered to a global interest rate easing cycle, central bank easing cycle, and probably equally as importantly, in the current context, to weakness in the U.S. dollar. We'll get into some of that, a little bit further in the conversation. And then last on this page, China value added. China's answer to deglobalization and how they're, approaching the changing geopolitical environment. It was really a pivot in economic priorities and support towards technology localization, consumption, value-added industries, where Chinese companies are capturing local profit share from Western multinationals. You can just think about the auto sector where Chinese EVs, I think people understand, how world-leading they become in the EV sector. And so in the domestic Chinese market, we're seeing major growth by those companies, and we've made some investments there as well. So that's, where we highlight some of the changing and probably less appreciated acceleration of earnings growth potential. But I think the real reason for the webinar today is that, there's been a major U.S. policy shift in terms of foreign policy, trade policy. It's not just trade, but the shift in terms of the U.S. support for the previous security and trade equilibrium that they really inspired in the aftermath of World War II, has changed rapidly. I think that's pretty clear. The old paradigm just doesn't seem to serve some of our interests. From a national security perspective, I think there's a bipartisan agreement that certain vulnerabilities have emerged. The fact that the industrial base, manufacturing employment, has been impacted by globalization, and we need to do something to revert. Some portion of that is kind of recognized also across the board, and we think that's all fine and probably is merited. But we do think that also, I'd say, looking at the market, I'd say we talked about this as it was playing out, but looking at the market reaction to Liberation Day, it's pretty clear that the markets believe, and we believe, that the U.S. was the disproportionate beneficiary of that global trade and security equilibrium that, was in place for nearly 50 years, and that there will be some price to pay in withdrawing from that. And that price, is kind of is laid out in point 2. I mean, we would say that there's a new investment credo that geopolitical priorities, in some cases domestic political priorities, are superseding economic and corporate optimization. So what that translates to is that we would expect, in diluting some of the benefits of globalization, we would expect some pressure on corporate margins are unlikely to appreciate, going forward, as they have for the last 10, 15 years at the peak of globalization. We think that return on invested capital is likely to be diluted somewhat as, U.S. companies are forced to reshore some lower return, labor-intensive activities that they were able to shed in the 80s, 90s, and 2000s. And there is a concept that we're familiar with in emerging market investing that we call national service. The U.S. government is calling on corporations and other entities, other institutions in what we would call national service. Again, this just means that we think that we should expect the relative growth on U.S. earnings versus non-U.S. earnings is inflecting in favor of non-U.S. and these are some of the drivers. And the next point, is just we need to remember that the tariffs are a growth and an inflation shock in the U.S. They're a growth but a deflationary impulse in non-U.S. economies. That's a huge shift in the equilibrium that's been in place. In the old paradigm, the U.S. was the safe haven currency. It attracted capital in times of economic stress, in terms of financial stress. The U.S. Fed played the role of the liquidity provider to the world. The U.S. Fed had the greatest room to maneuver. But now, in the new environment, given the changing priorities that we've well articulated, or that the U.S. government is articulating, I should say, that suggests that we're going to have higher inflation, a higher propensity for inflation in the U.S. The Fed will have less room to maneuver. And we believe it's likely that foreign central banks will have the greater room to maneuver. We think that that's a major inflection point in capital flows, and we're seeing, the dollar weakness in response to Liberation Day as a manifestation of that inflection point. We should also remember, in speaking of the impact on the dollar, the next point is that a mirror image of a shrinking current account deficit or trade deficit, which is clearly, the objective of the current government, and we don't think that's going to change. That implies or necessitates a commensurate reduction in the capital account surplus. What that means is, we're going to have less imports and more exports. But what that means is much less recycling of a repatriation of capital from foreign economies coming back into U.S. dollar bonds or equities. So it's a major change in the supply-demand relationship for U.S. assets. Again, all else equal, a weaker U.S. dollar should be expected. And so, moving to, we're looking at, how traditional NATO and trade allies are being mobilized by some of these changes. We think it again suggests a ballast to earnings growth potential in non-U.S. as places like Europe or Asia are accelerating defense spending. For the first time, Europe and Germany are engaging in fiscal expansion, eliminating the fiscal brake that prohibited them from spending more money. They're taking on, the U.S. is looking to reduce fiscal spending. Europe, Asia are increasing it. Again, we think that should be positive for non-U.S. relative earnings growth. And finally, certainly you're looking at, non-U.S. corporates and consumers are looking for alternatives to U.S. goods and services in the current, geopolitical and trade environment, kind of as a response to the aggressive tactics that the U.S. Expressed, on Liberation Day, say, and in the change in security support for places like Europe, et cetera. Those we think are, important shifts. We think that because 40% of U.S. revenues, of S&P 500 companies come from non-U.S. sources, some portion of that is more at risk than it has been, in some time. Next, China is being forced to accelerate its kind of pivot, its rebalancing of its economy, away from export activity, away from property or infrastructure, and towards domestic consumption, technology, domestic activity. And so, we think that this shift in geopolitical environment just further accelerates that. Again, presenting, at least for stock pickers like us, significant opportunities to find, companies that are benefiting from this improvement in earnings growth. And so, this deteriorating geopolitical environment is actually is a positive for many countries or industries or companies within our universe. And last is India, which is the relative winner, really in the changing geopolitical world, in the changing trade equilibrium. I'm gonna let Anuj elaborate on that in a few minutes because he's the expert there and will tell you a really exciting story. But I guess my conclusion is that regardless of the tariff rate, the policy pivot that we're clearly seeing signals to us a sustained inflection point in relative earnings growth and capital flows in favor of non-U.S. equities. And I think it's kind of a wake-up call for investors around the world that find themselves underweight international equities or EM equities. Let me go on to the next page. So now, there's a lot going on this slide. I'll just try to simplify it. And we're looking at a 30-year history of the long kind of cycles of equity relative performance. You can see there's a clear, on the bottom panels, you can see there's a clear inverse correlation between the dollar, which is in the blue line, and the relative performance of EM equities relative to the S&P in the yellow line at the bottom. The last EM relative bull market peaked in 2010, 2011, as the US dollar bear market was bottoming. Since then, there's been about a 65% appreciation from trough to peak. That peak was in September of 2022 on the dollar. That happened in the context of peak hawkishness or fear of inflation, but peak interest rates and peak inflation didn't happen until the following year. But the dollar never made a higher high than it did in the fall of 22. For people who are kind of kind of watchers of markets and take cues from what the market's trying to tell you, that's kind of an important lower high, I would say, on higher interest rates in the U.S., peaking of interest rates in the U.S.
And maybe just to add to Michael's point, typically, we see a 8 to 10 year cycle, for a dollar bear market, a bull market. But this time around, it's been almost extraordinary where, we're in a dollar bull market for 14 years, defying previous market cycles. And some of the reasons were, obviously the war in Ukraine and Russia that created a little bit more of a risk-off environment for international assets. And then obviously, geopolitical tensions with China. But, in our view, we are, what we assumed was long overdue for a cycle turn in our favor or entering a dollar bear market. I think this is early confirmation of what's playing out as Michael mentioned.
And the point, the last point on this chart, exactly what you're saying, is that, the dollar had another attempt at a significant rally, in the aftermath of Trump's election win. You can see that there on the chart. And then since then, and accelerated by Liberation Day, it's completely rolled back over and went below the lows of the last couple of years, which is another important technical kind of factor. But the Trump administration's, or I should say, Trump's economic advisors, a number of them, have been very clear also that they believe that a strong U.S. dollar has been a tax on U.S. manufacturing, and whether and they I'd say there's kind of they're critical of the dollar being too strong, and that's been a headwind for job creation and for capital coming back and reshoring to the U.S. So whether the administration kind of moves to sort of serve their interests through higher tariffs, aggressive unilateral tariffs, or not, we think that the safety valve will be a weaker dollar for them to be able to affect the end game that they're looking for. I think in addition, the fact that we've all seen, Trump and mostly Trump, but others in the administration critical of Fed leadership. There's going to be a change in the Fed. We're going to have to watch carefully, but the market's confidence in independence of the Fed is going to be very important as a potential signal for whether the dollar is truly entering a bear market over the coming year. But I think just to keep things in perspective, the bottom yellow line at the bottom of this page is kind of the relative performance of EM. You can see how depressed it is. Valuations are also very depressed. The little blip up and to the right at the very bottom of the page is the tip of the iceberg. If we're actually moving into a mean reverting cycle where EM begins relative outperformance. We are so early that it is not at all too late. And we can tell you from flows into the asset class that you are not too late to start thinking about your current positioning. This next page, is kind of just laying out something similar, but looking at relative valuation rather than relative performance. Just kind of making the point of how cheap EM equities are relative to global or U.S. S&P. This is a 20-year chart. It kind of shows that EM relative valuation troughs at around 55% of the S&P multiple. It peaks at parity with the S&P multiple. So that implies a potential 100%, outperformance over a bull market cycle, which is a lot. And in November of 17, which was kind of Trump 1.0 victory, the EM multiple was only at the mean. The EM multiple was at the mean of 77%, and during pretty early and then throughout, as this sort of protectionist policies began to become articulated, there was underperformance on EM and on valuations, and we went into a one standard deviation kind of decline. We traded between the mean and one standard deviation below the mean throughout kind of Trump 1.0 administration. We then had COVID, and then the big driver where you see on the chart, we went to a near 2 standard deviation discount, was Russia's invasion of Ukraine. So really to us, Russia invasion of Ukraine was a critical kind of catalyst that triggered the historic discount that we see today, on EM on a relative basis. At the very bottom, at the far, end of the bottom chart, you can see after Trump 2.0, we were already at one standard deviation below when we entered, and we had said, we think that a lot of negative, a lot of concern about, Trump, 2.0 policy mix is likely priced in. A lot of concern about, conditions, macro conditions in China, geopolitics is already priced in. And then, of course, in the immediate aftermath of the election, EM went to a record discount of roughly 50%. You're buying $2 of EM earnings for every dollar of S&P earnings. In our fourth quarter later, we kind of said, that felt like a capitulation, and we believe that, looking forward from here, it is very likely that there's more upside than downside in relative performance for EM. And then we got Liberation Day. We got, the sort of the U.S. walking back on security assistance to NATO, et cetera. And those, that change in policy, as we laid out on the last page, we think is a critical catalyst that will begin the next EM relative bull market phase. This next page, the dotted line is supposed to be right around the tip. I mean, we're just making the point here. Are we past peak dollar? This is just kind of amplifying what we just talked about. But the point we want to make is that large investors and allocators are very sensitive to their view of the outlook for the dollar. If they believe that the dollar remains in a bull market, they will not go overweight non-U.S. equities or non-U.S. assets. Global investors are heavily underweight, EM or international. They're waiting to see confirmation in the dollar. Once that happens, you will see, we believe, a very significant reallocation of capital. That has not happened yet. The point is that we believe, and this chart doesn't really show, it goes to March, it's not showing up to May. In May, as we said, we broke below that support line that the dollar held through, the last 2-3 years post Russia-Ukraine, post the interest rate normalization. We think that's a very important signal, and that we're getting close to that potential major reallocation. That's the point we want to make there. Just moving on, I know there's a lot of reticence vis-a-vis China. That's probably the number one question we get with clients is, well, what about China, and how are we comfortable allocating there? We agree that there are challenges. Geopolitics, Taiwan, property slowdown, we're not, and we believe there are long-term challenges. But we would say that the skepticism has become so entrenched, and it has been, well-placed, but we just showed you the valuation. The valuation on China is kind of as low as the low. It's at record lows as well. It's come off the lows, since last September. But, we've been saying that there's a lot of bad news in the price for China. And then since last September, we saw a pivot. The Chinese government really reversed and picked up stimulus and support for property sector consumption, consumer confidence, much more fiscal easing, monetary easing. And then more importantly, I would say, is the regulatory flip from headwinds to tailwinds in terms of support for private sector entrepreneurs, for the technology sector. So that's a key change, and we're seeing Chinese equities begin to improve just a bit. But more importantly, probably, and particularly for our portfolio, for those who have been following DeepSeek, DeepSeek in terms of China's AI aspirations is evidence that they have made significant. They're the number 2 investor in terms of patents or engineering talent that's focused on AI and advanced technology. The BYD is, kind of the Tesla of China, if you will. They have come out in the last quarter with the significant advances in automated driving technology that were not expected. CATL, which is the moniker for the world's leading integrated lithium-ion battery company, they have the world leading technology, the lowest cost, and they have come out with super fast charging, 5-minute charging cycles. Leading the world. Huawei and Xiaomi have also recently come out with significant technology advances that, again, I think it's a wake-up call to global investors that from a technology perspective, China is better than you think, and it is becoming investable again. It's good enough or world-leading technology at a much lower cost. And so for our portfolio, that's where we're seeing opportunities: value-added industries, technology, self-sufficiency, localization, biotechnology, digitization, cloud migration. That's been improving, as we've been saying, for the last couple of years, but we now have a catalyst, so global investors and analysts are really beginning to focus in and see what we've been talking about. The other point I want to make about China is, there's a lot of concern about the current trade environment. We think China trade and exports is a developing story. There's reasons to have concerns for sure in the current kind of protectionist 2.0 that we're living through. But Chinese exports have been shrinking for really decades. They peaked in the lower panel here. They peaked at 30% of Chinese GDP. They're down to below 20%. So they're becoming much less reliant on exports, as I mentioned earlier. And in the upper panel is U.S. export. U.S. exports to China, Chinese exports to the U.S. Peaked in 2006 at 7%. They're below 3% today. So some of the commentary that you hear about China can wait this out. This is not it's not a death knell for China or even for economic growth. It's 3%. There is some transshipment. We recognize that. But we do not think that even super high tariffs will be catastrophic. We think that that was one of the reasons that the U.S. has already kind of climbed down some on the level of China tariffs, and we had that kind of recent negotiations to reduce the adverse impact of the tariff rates. I mean, other EM countries, whether that's Mexico, Taiwan, Korea, have a much greater percentage of their GDP going to U.S. exports. So, China is actually somewhere in the middle. India is probably the best. China is a very consumer-driven economy, and they're somewhat shielded from, I think most investors don't really appreciate that. So we are definitely seeing opportunities, but, as we've said, India is our largest weight. It's our most, kind of exciting, investment destination. I'm going to turn it over to Anuj, who's our expert there, and he's going to walk you through the story.
Thanks, Michael. Sure. Very compelling case, for our audience to think about considering their allocations for international EM as well as India. So if for those that are not convinced as yet, I hope the India discussion and the exciting opportunities we are seeing here gets you through the finish line. I'm sure most of you may know that India is the most populous country in the world with a population of 1.4 billion. It's the fastest growing large economy in the world, actually the fifth largest. That's growing 6 to 8%, as Michael mentioned, in real terms, and about 10 to 12% in nominal terms. And just given the sustainability of this rate, by 2030, India is going to become the third largest economy in the world, which creates a lot of opportunity for us, just given the underlying sort of GDP growth that we're seeing in the economy. But when we think about capital allocation within EM and also launching an India dedicated strategy, our excitement comes not really from the India 1.0 that I talked about. They're all tailwinds, don't get me wrong. But in terms of capital allocation, what gets us exciting, from a top-down perspective, is what's happening, from an economic reforms agenda, from a political stability perspective within EM. And I think really, India stands out to the point we think it's the breakout investment destination within EM, just thanks to the productivity enhancing economic reforms that have been implemented over the past 5-7 years. That's really kickstarting a virtuous investment cycle in the country. And I just want to highlight a couple of really transformative sort of tax legislation implemented. Without getting into too many details, the goods and services tax, in our view, has been the most transformative, where this legislation has really leveled the playing field between unorganized and organized players, and has accelerated the formalization of the economy, to the point where the tax code has been simplified, where almost 8 to 10 local and tax levies have been collapsed into a single GST tax. And as a result of which, we've seen over 6 million plus SMEs and MSMEs that have now entered the formal economy and are now paying tax. And the numbers are pretty staggering, where tax collections have doubled over the past 6 years, while the economy has grown about 50 to 60%. So that increase in tax efficiency, tax yield, has now been reallocated into productivity enhancing infrastructure, capex, railroads, bridges. What's happening in India today is what played out in China 20, 30 years ago, when they build their economies, when they build their sort of infrastructure. So this is, India's sort of time. And we, internally joke that, India is the new China, especially given what's playing out with geopolitics.
But it's a democracy.
It's a democracy, and with the rule of law. So that's what gives us comfort in terms of capital allocation. So that's really on economic reforms. And just to add a few more sort of center-right policy that are played out, India's cut corporate tax rates from 35% to 25%. They've also sort of legislated very attractive tax subsidies for greenfield manufacturing, in light of what's playing out with geopolitics, de-risking from China. The government is now offering anywhere between 4 to 6% of sales or incremental sales as a financial subsidy for global corporates that want to set up shop.
And this is part of the whole supply chain diversification. They're trying to encourage those multinationals to move from China to India.
Yeah, exactly. And one last thing on tax cuts. This February, the government announced a pretty landmark tax legislation where they cut taxes on the entire middle class. So if you now make less than $30,000 in India, you pay no tax. So that's going to be very stimulative, going forward for consumption. Moving on to what really excites us, where we are seeing a lot of bottoms-up opportunities as well, is what's playing out with digitization. India's digital ecosystem is just about inflecting, and think about it maybe 10 to 15 years behind China. And the reason for the inflection is thanks to a couple of companies we actually own in EM and the India Fund, such as Reliance Jio and Bharti Limited, that are really sort of democratizing high-speed broadband data, offering over 700 million consumers now with a smartphone, data rates at $2 to $3 per month, which is almost the cheapest in the world and even cheaper than Africa. So what this is really doing is it's now enabling over 750 million Indians to order food online for the first time, buy goods online. It's really transformative. And what's played out in China over the last 20, 30 years or the last 20 years is just starting in India, from a digital standpoint. So that's where we're finding a lot of exciting opportunities. I'm going to talk more about that in a bit. Number three, I think, talking about the icing on the cake, and why the case for India has become so strong and resonates with a lot of people we speak to is the tectonic changes in the geopolitical landscape that are playing out. I don't need to tell the audience, but there's rising tensions between the U.S. and China, and India stands to benefit. It's the disproportionate beneficiary of these changes, where India is increasingly pivoting towards the U.S. and the West as a strategic counterbalance to a rising China. So India has military as well as economic ties with the U.S. and the West now, and that's further sort of solidifying, just given what's playing out with China and Asia as well. And as a good example about our supply chain diversification theme, our China plus one strategy is what's playing out with Apple, really, right? If you go 5 years back, Michael, we talk about it all the time, and Robin may be news to you, but Apple was producing only 1 to 2% of their iPhones in India about 5 years ago, and today that number is 20%. And as per recent announcements from Apple and press releases, that number is going to go either to 30 or 40% in the next couple of years. And also, if you just think about the risk mitigation strategy, if you're a global corporate or a U.S. manufacturer, that has maybe 80 or 100% of your manufacturing today in China, your board of directors is sort of giving you a wake-up call to think about a risk mitigation strategy or a China plus one strategy, just given the environment where we are. So that's going to be a big sort of opportunity, from a top-down perspective for India, this virtuous investment cycle we're talking about, as well as from a sort of bottoms-up opportunity set. And we're finding a lot of exciting opportunities there. And last but not the least, Michael talked about it. India is the biggest relative winner in tariff-related uncertainties and a global slowdown. If you really think about it, India is predominantly a domestic consumer-driven economy with a very low share of global trade. So even assuming that the 26% sticker tariff that was announced for India is implemented, that's the worst case scenario. The impact on GDP growth is only going to be anywhere between 20 basis points to 50 to 60 basis points. And the reason is India's exports to the U.S. In terms of goods is only 2% of GDP. So it's a very small impact. And just to put it another way, The economy is growing 6.5%, 7% in real terms. So even if you adjust for the worst case scenario, it's still growing 6 to 6.5%, which is still a big win compared to the growth rates we're seeing elsewhere in the world. And the mitigants out here are, India's in advanced stages of signing a bilateral trade agreement with the U.S. I'm sure a lot of headlines are coming on that being further accelerated, and we expect an announcement anytime in between July and October. So once that takes place, tariffs are likely going to settle much lower than the sticker 26%. And on top of that, President Trump and Prime Minister Modi have sort of together announced that they want the bilateral trade to ramp up to $500 billion by 2030, compared to about $130, $140 billion today, which is a astronomical number, but directionally very positive, where trade between both the largest democracies in the world are going to increase. So I think that makes us very confident, comfortable of our big allocation in the EM strategy, as well as our dedicated India strategy. So that in a nutshell is the India opportunity. Just quickly on the next slide, we talked about top-down drivers for India economic growth, but where are we seeing the best opportunities? Digitization, like I'd mentioned. What we are trying to do is really invest, in the leaders in each digital sub-vertical. So whether it's food delivery, Zomato is the largest food delivery player in India with 55% market share. And it's also disrupting e-commerce now. So Zomato owns an app, or it runs an app called Blinkit, which is really quick commerce, where you can now get an iPhone in 12 minutes instead of waiting 2 days. It's really...
You're seeing this whole quick commerce phenomenon spreading around the world, but it started here in India. They kind of proved the model out there.
Exactly.
It's now traveling around the world.
Yeah. So I was in India actually in November, and my wife wanted diaper rash cream for my 1-year-old baby, and she was freaking out. And I downloaded the app, and I got it in 12 minutes. And I haven't seen my wife so happier. So I think so. That's the great opportunity that we're seeing. India, very early stages, high growth. And that's going to continue for 5, 10, 15 years to come. Quickly on consumer finance, once again, credit penetration, consumerism in India is probably 40 years behind the US. So, credit penetration as a percentage of GDP is about mid-teens today versus 75 to 100% for most developed economies, and Korea as well in that bucket. And so, we have a, once again, 10, 15-year runway for mid to high teens industry growth, and we are backing, the best private sector players like a Bajaj Finance.
That's the reason, our clients always ask, well, what about the valuation premium on India? Yeah. It's Anuj is talking about this 15-year growth, runway that we see. We see it across the board in so many companies and industries. That's why, you need to be willing to pay a higher price for access to Indian growth. And quality of...
And this is also what we do at Baron Capital, right? Yeah. We take a long-term approach to investing and really believe in compounding stories. So, we are willing to be patient if valuations may optically look expensive over a 12 or 18-month perspective. But taking a 3, 5, 10-year view, you're going to make a lot of money. And, we've done it.
We've shown that.
Knock on wood, we continue to do that. Financialization of savings is also very exciting, where we're seeing this structural shift of household savings from gold and real estate into equity products, mutual funds, and sort of other life insurance related savings products. And the equity ownership as a percentage of GDP today is in low teens. And that number was similar to the US in the early 1980s. So the value creation story we've seen in the U.S. with the equity markets, India is just beginning that journey. So what we are trying to do is investing in the next Charles Schwab, investing in the next T. Rowe Price or Fidelity, which is or Baron Capital, which is very exciting. Just given how low the penetration levels are there. And the global security supply chain diversification theme. I talked about Apple as being the beachhead in terms of the opportunity set, but there are a lot of under the radar businesses like a Keynes technology that forms part of the supply chain for various industries. So Keynes is a business we've invested over the last couple of years, and we've more than doubled our money on this one. They provide mission critical electronic components to various industries: EVs, aerospace and defense, medical devices. And instead of importing it from China or Malaysia, Southeast Asia, they're now doing it in-house. Just with the tax subsidies that the government is offering, makes it very sort of ideal for a lot of manufacturing to be done locally. And this is really the play on supply chain diversification, import substitution. This business is growing 60%. And should continue to grow 40, 50% for the next 5-7 years, which is once again the India story, the high growth, exciting opportunity. And last but not the least, the formalization of the economy. I talked about it in terms of the GST implementation really accelerating formalization. So what we are doing is picking the best branded, organized, tax-paying entities that are disproportionately gaining market share. Trent is a great example, which is the equivalent of Zara of India. Tata Consumer Products, the equivalent of P&G, Procter & Gamble. So a lot of early stage high growth opportunities in India that we've invested in. So I'll quickly sort of move on to where we're also finding opportunities elsewhere besides China and India. Taiwan is also exciting, just given, in the EM universe, it's the AI proxy. I'm sure the audience has invested in NVIDIA and then made a lot of money there, hopefully. But the way we play EM, the way we play AI within EM is investing in, the picks and shovels of the semiconductor industry or the AI industry. For example, TSMC, the NVIDIA chips are actually manufactured by TSMC that has over 90% share in high-end chips. ASPEED is another really exciting business. eMemory, Delta, they all play into the sort of the AI ecosystem. So, these are businesses that a lot of people in the audience may have not heard of, but they all participate in the AI mega trend. And that's the
cloud, cloud AI. It all ties back in one way or another to the supply chain that comes out of Taiwan. Right. That the kind of the suppliers of the key components are often coming from emerging market companies.
That's right. And similar for Korea, we're also seeing AI-related opportunities in Korea. SK Hynix, Samsung, they're manufacturers, producers of high-end memory, high bandwidth memory, which goes into AI data centers with increased compute. So that's also one way to play AI. And then, very interesting what's playing out with defense and global security. That's a theme for us in both portfolios where, as the world is increasingly, becoming uncertain, we are seeing opportunity in that uncertainty where, defense-related businesses, are really sort of growing now. That may have been value stocks historically. They're transitioning to growth in businesses similar to, Hyundai Heavy, which is one of the world's largest ship manufacturers or shipbuilders. This is likely, this was probably perceived as a cyclical value, deep value sort of stock or investment, which is actually transitioning to becoming a growth opportunity, just given what's happening with national security, defense, infrastructure ramping up. So once again, very exciting here. So just quickly, also Latin America, Brazil, there are a lot of opportunities, in our fintech disruption theme, where the entire industry today is dominated by 4 or 5 large banks that don't necessarily have the best customer service. It's sort of archaic in their approach, to investing or to capital deployment. So we're seeing, a lot of opportunities in credit penetration, fintech disruption, as well, along with a few other businesses like Mercado Libre. That's a play on e-commerce. I'm sure a lot of people in the audience have heard of that story. And last but not least, we've got a few other themes spanning across multiple countries, that sort of play into our logistics, digitization, consumption themes. Coupang is the Amazon equivalent in South Korea. InPost is a key logistics player that enables e-commerce in Poland and is now expanding in Europe. And Dino Polska, once again, is a consumer play in Poland where it's gaining a lot of market share from mom and pop retail. And so I'll hand it back to Michael just to give some summary thoughts, and we'll open it up for Q&A after.
Thank you, Anuj.
Sure. So just to sum it up, reasons to reassess an allocation to EM or the size of your allocation to EM. I think we laid out the relative valuations are still at multi-decade lows, and we think that creates significant, opportunities, risk reward, attractive risk reward. We think the dollar weakness is always a key, if not the key catalyst for large investors in terms of capital flows, and it also drives relative earnings potential and sustained EM outperformance. Deglobalization, I think, again, people think of deglobalization as being somehow negative for EM. We think that because it requires this global capital reinvestment cycle, which means kind of a capital allocation to industries that have been starved of capital for decades during the reduction of capital intensity phase. Now countries all around the world are trying to become, bring manufacturing back home. There's a huge investment in defense, manufacturing, infrastructure. We're seeing it everywhere, but those are more capital intensive. Those are, industrial, real asset, pricing power is accruing to the owners of industrial pricing power and real assets on the margin. And those, industries are much more heavily concentrated in EM economies or EM indices, which is another reason we think there's going to be an inflection point in relative performance. India, I don't need to belabor this one. I think we've made the point, they're the winner of the geopolitical environment. Productivity miracle happening there. That's got, many, many years to run. And again, we see, Eitan, one of our senior analysts that covers technology and semiconductors, is in Taiwan this week, looking at some of the AI opportunities that we see there, and we just see a long pipeline of possible investments, and we've made a number of them already, and that's another area of great opportunity for us. With that, I think we've summed it up. I think we can go to the Q&A.
Yeah. Thank you both so much. I think you actually covered almost every question that came in, but I think we have time for one. Also, when do we get Zomato here? And let's send your wife some flowers, because diaper rash cream is exciting, but I'm sure we can make her smile a little more. One of the questions that came in was about specifically, sort of this Trump tariff rollback, right? And things starting to normalize here. And if this continues and the market sort of picks up again in the U.S., what does that mean for the thesis for EM and India abroad?
Okay, so I think it's really important to recognize that, tariff rate in the U.S., we're still talking about moving from 10 to 20% probably when it's all said and done. We don't know exactly where we don't know where EU is going to come out. China also is far from settled, but tariffs are going to be at least 3, 4, 5 times what they were coming into the year. That is definitely a burden in terms of higher tendency for higher inflation in the U.S. and potential pressure on corporate profit margins in certain industries. So this problem hasn't gone away just because we have reduced the kind of the outlandish levels of proposed tariffs back mid-April. And I think more importantly, the U.S. administration has clearly articulated their objectives. The objectives are a material reduction in the current account deficit, reshoring of manufacturing activity and jobs, job creation here. All of that, that is the goal that's going to remain in place. And so, we would just say that the genie is out of the bottle, if you will. Countries are, from a security perspective, being forced to spend a lot more money on defense and other areas, kind of fend for themselves. And so the big picture, inflection point that we talk about, while it might be, the immediate impact is less than the worst case scenario, the big picture story we think is very much intact. And we don't think that's going to change.
And also, we pay attention to, what outcomes potentially will play out, but we really bottoms up stock pickers, and we take a long-term view to investing. And like I talked about, a lot of the reforms playing out in India, digitization, it has no impact. Tariffs have no impact. Macros are gonna not really change our thesis out there. So, while we monitor top-down developments on tariffs and other things, we're really investing in long-term compounding stories across all funds.
And let's also kind of remember and keep in mind that it's been 14-year, outperformance bull market cycle for U.S. stocks.
Of course.
Valuations are at peak levels. Valuations on non-U.S. are at trough levels. We now have this catalyst that has come into view that is suggesting, a potential paradigm shift. To us, it may play out over a number of years. It's likely to play out over years. It's not going to happen all at once. But we do think that there is a high likelihood of outperformance just given the valuation discount, and it appears things are beginning to change on the margin. I would say that whether it's Europe, Canada, these populations are now looking for alternatives to U.S. products in some areas. That's not going to reverse on a dime because we reduced tariff rates from 20 to 10 or 140 to 30. I think the valuation differential is set to narrow from here.
Okay. That makes sense. I think when you think about what you said, Anuj, and you've been speaking about Michael and active versus passive in this space, and that was another one of the questions, right? And they talk so much about our bottom-up fundamental investment process and the deep research we do. I know that in India specifically, there's been a lot more passive investing historically. If you want to just elaborate on that a little more.
Generally on EM, I would just say, and I mentioned this, we think it's a great time, to be an active investor. Anytime that there's major changes happening in the world, and this really dates back to, it's really Russia, Ukraine, that I would say we came as, okay, this is a paradigm shift in terms of the impact of geopolitical, priorities beginning to supersede economic optimization. So we have to be cognizant of that as investors in looking for themes or stocks or companies, businesses that are well set up for the decade ahead, say. So I would say, that to us, that means you want to have an active investor in that type of an environment of significant change where not everything has become clear yet. But then India also, I think we've demonstrated significant alpha, significant outperformance on stock picking, bottom-up stock picking in India.
And also,
really
I think the opportunity that we see in India is really exciting. And when I talk to clients, and when Michael and I also talk, I consider myself very fortunate to be a knowledgeable investor in this current seat, having the opportunity for the next 20 years for value creation, both for myself, my family, for the firm, and for potential clients.
You're in India 4 times a year, right?
Yeah.
You've built up an incredible array of relationships, whether that's companies, buy-side relationships, and
He's just going there for the 12-minute delivery.
He's there for
But that's true though, because the sort of proprietary network and relationships that we've built, enables us to interact with very exciting under-the-radar businesses, 300 million market cap businesses, sub 1 billion market cap businesses that are very high growth, no sell-side coverage. And the ability to sort of through friends, fellow investor friends on the ground, getting those introductions and then interacting with these really ambitious entrepreneurs, is really exciting. For what we do at Barron, and specifically me, from an India perspective. So that's the opportunity for outsized returns, to prevent the landmines, within EM. Once again, just across the floor, we do a lot of work to sort of vet, who we invest behind. As Ron says, we invest behind people. In an index, you're investing across 1,000 companies in EM and about 200 companies in India. And I would say, you don't want to probably touch 80% of them. So I think it's really important to have an active approach in EM, just given there are a lot of pitfalls as well.
I'm totally convinced. I think we have time for one more question. This is sort of the same question over and over, and it's about won't the U.S. tariffs hurt the foreign companies that are trying to sell into the U.S.?
Yes, it will. We have almost zero export-oriented exposure in our portfolios. Again, a great example as to why you want an active manager. We've taken that position for a long time. We've always been focused on domestic growth opportunities in the EM countries that we invest in. India is, as Anuj says, very much a domestic, consumption, local economy. But what we own in China, where we had a little bit of export exposure, very early in the year when we started getting, kind of sense that the protectionist rhetoric may be kind of dialed up early in the administration, we did reduce that just a little bit, but we have so little that, on a direct basis, as investors in the EM and the India, fund, we're very insulated from that.
Amazing. Okay. Well, I think we're really down to the last minute, so great job there on timing. Thank you, everyone, for joining us today. Thank you, Michael and Anuj, for your expertise through all these years in navigating what I know hasn't been the most fun place
Trying to do our best.
We're still smiling. I think you illuminated a lot of what we do.
Emerging markets is more exciting than U.S. investing.
Well, I believe it.
You never know.
I think we illuminated a lot of what we do at Barron, which is long-term investing, bottom-up fundamental research, getting to know our companies really well, having incredible access to these management teams, be it here in the U.S. or abroad. I hope that came across today. The closing thing is there's going to be, I think, a survey that pops up on the screen, and we'd love to hear your feedback on that. And then a replay will also be available in the coming days. Again, thank all of you for tuning into this today. You can watch it again and see how informative it was. I believe it was very informative. And thank you for investing alongside us. Again, thank you, Michael and Anuj, for being here. And that concludes today's webinar. And go Knicks.
Go Knicks.
Go Knicks.